Welcome to Stock Spotlight. I'm Michael, your guide to the stock market. In each episode, we analyze companies that have earned a watch or a buy rating on my 33-question research checklist. Today, we're shining the spotlight on automatic data processing, ticker symbol ADP, and uncovering what makes it a standout investment opportunity. Join me as we explore the insights and strategies that empower savvy investors like you to make informed decisions. Let's dive in. The first section is my investment checklist and database. There are no new updates here. I've still screened 191 stocks across 9 sectors, but I am going to be doing a couple of new stocks in the next few weeks. They are ticker symbol DUOL, ticker symbol FAST, ticker symbol EVO or EVVTY, and ticker symbol SHOP. That is Duolingo, Fastenal, Evolution Gaming, and Shopify. The mean quality score is still 58% with a standard deviation of 15% and a top quartile benchmark of 70%. No change to my company size distribution, which is at 83% large caps, 16% mid caps, and 1% small caps. Same with sector distribution. Consumer discretionary still makes up the most at 20% of stocks screened, followed by information technology at 18%, industrials at 16%, healthcare at 13%, and everything else below 10%. For ADP, my overall stock evaluation is a quality score of 70%. This is good enough for a 75th percentile and a pass rating. I also like to look at other sources, and they are Schwab and Guru Focus. Schwab gives ADP an A rating, and Guru Focus gives them a 96, which is in the 87th percentile of the companies in my database. As you can see, all 3 sources have rated ADP quite well, so I thought this would be a good company to dive in further. First, I'd like to mention that I'm recording this episode just as ADP released its Q1 2025 earnings. From the early glance at things, it looks like a pretty solid quarter with a double beat on revenue and EPS versus analyst estimates. Okay, so now that that's out of the way, I'll start this episode by providing an overview of ADP's business and industry, including its classification, market capitalization, core operations, business segments, geographical presence, and customer base. Let's first talk about the industry, sector, and market cap of ADP. From a classification standpoint, ADP was previously classified under the information technology sector, but has since been reclassified as part of the industrial sector due to changes in the GICS standards, which is the Global Industry Classification Standard, effective March 2023. It also now falls under the business and consumer services industry, which reflects its primary business in HR management services. As of recording on October 31st, 2024, ADP has a market cap of $118 billion, which would be classified as a large cap. Next, I'd like to talk a little bit about their business background and also their product services. First, ADP was founded in 1949 by Henry Taub as a manual payroll processing company, and they have transformed into a global leader in human capital management solutions, also known as HCM solutions. Over the decades, they have embraced technological advancements, moving from manual systems to automated and cloud-based solutions, with recent leadership transitions from Carlos Rodriguez to Maria Black in 2023, further accelerating ADP's evolution from a payroll processor to an HCM innovator focused on data-driven insights and the future of work. The ADP Research Institute exemplifies ADP's thought leadership in workforce analysis through its insightful reports, such as the October 2024 National Employment Report, which revealed a robust increase of 233,000 jobs in the private sector. This report not only highlights ADP's commitment to providing real-time labor market data, but it also underscores its role as a trusted source for understanding employment trends and economic conditions. ADP offers a robust portfolio organized around 3 core pillars. The first one is U.S. Human Capital Management, or HCM solutions. These are comprehensive solutions for managing the employment cycle, which includes payroll, benefits administration, talent management, and compliance services. Key platforms include Run, powered by ADP for small businesses, and ADP Workforce Now for mid to large size enterprises. The second pillar is U.S. HR outsourcing solutions. These are tailored HR management services that help organizations streamline processes and reduce compliance risk, serving clients of all sizes. In my research, this is an area of the business that not many of their competitors have. Third, there is Global Solutions, which is multi-country and local in-country solutions for employers of all sizes, including ADP Global Payroll, which operates in over 140 countries. ADP pays over 15 million workers outside the United States and provides year-end regulatory and legislative tax statements as part of its global payroll services. ADP's value proposition lies in simplifying work processes and providing data-driven insights that enhance efficiency for over 1.1 million clients worldwide. While ADP's payroll processing and compliance services are essential for business operations, some advanced HCM solutions may be seen as discretionary, particularly for smaller companies. This essential nature of their core services ensures stability and recurring revenue, even during economic fluctuations. Next, I want to look at their business segments and geographies. First, from a segments perspective, ADP operates through two main business segments. The first one is employer services. This segment is ADP's largest, contributing about 68% of total revenue in fiscal 2024 and growing 8% year over year to $13 billion. Employer services offers a comprehensive range of HCM solutions, including payroll, benefits administration, talent management, and compliance services, and even specialized offerings like the Work Opportunity Tax Credit that you may have seen sent to you when you apply for new jobs. It operates on a cloud-based subscription model, which provides recurring revenue and high switching costs for clients. And this segment saw a 15% increase in EBIT in fiscal 2024, reaching $4.6 billion. The second segment is Professional Employer Organization, or PEO. The PEO segment, known as ADP Total Source, accounted for about 32% of total revenue in fiscal 2024 and grew 4% year over year to $6.2 billion. This segment provides comprehensive employment administration, outsourcing solutions, and co-employment relationships. Despite its growth, the PEO segment experienced a 6% decrease in EBIT to $922 million in fiscal 2024, likely due to its more labor-intensive nature. Additionally, interest on funds held for clients, while not a separate segment, is a significant revenue source for ADP. In fiscal 2024, it contributed $1 billion to total revenue, up from $813 million in fiscal 2023, benefiting from higher interest rates as the average interest yield on client funds increased from 2.4% to 2.9%. ADP offers its HCM solutions in over 140 countries and territories across North America, Latin America, Europe, Asia, and Africa. The primary market for both employer services and PEO segments, though, is the United States. The PEO business operates exclusively in the United States. For international operations, based on the global revenue line item that I found in their 10K, international operations contributed about $2.5 billion, or 13% of total revenues in fiscal 2024, which grew from $2.3 billion in fiscal 2023. That was a 9% increase. While ADP has a significant global presence, the majority of its revenue still comes from North America, particularly the United States. This reflects its strong domestic market position in HCM and PEO services, while also highlighting its international reach, which is more extensive than many of its competitors such as Paychex and Paycom, who primarily focus on the US market. I'd now like to look at ADP's customer base and market dynamics. First, they are highly diversified with clients across various industries and countries, and no single client accounts for more than 2% of total revenue. This is really nice to see. End consumers are typically HR professionals, payroll managers, and business owners who seek efficiency and accuracy in managing complex tasks while valuing compliance assurance and user-friendly interfaces. They are motivated by the desire to minimize administrative burdens, access expert support, and leverage data-driven insights to make informed decisions. I usually then like to next talk about seasonality, but in ADP's case, seasonality was not mentioned in their latest couple of 10Ks, which suggests that there is limited seasonal impact on the business. I'd then like to go a little bit into industry attractiveness. As you've heard me in past episodes say, finding a good industry is as important as finding a good business Overall, this is an attractive industry in my opinion, due to its recurring revenue streams and low to moderate threats from new entrants, suppliers, and substitutes. But the high level of competition does remain a concern for potential investors. A couple things I wanted to highlight about the HR services or HCM industry. It does show strong financial metrics across competitors. From what I gathered, the industry grows from anywhere between 5 and 20% revenue growth, with usually 45% plus gross margins, 15% plus free cash flow margins, and generally 20% plus return on invested capital. In terms of market dynamics, the first thing I'd like to look at is the TAM, or total addressable market, and market share. ADP estimates a 150 billion TAM, which includes HCM software, payroll services, HR outsourcing, and related services. Their current market share is about 13% based on fiscal 2024 revenue relative to this TAM. The core HCM market was valued at around 22 billion in 2022 by ADP Research, so it is a little bit smaller than ADP's total TAM. In terms of industry trends, key industry trends that I've noted include increased adoption of cloud-based solutions, which many of ADP's competitors offer, as well as integration of AI and machine learning in these platforms, and a growing demand for data-driven workforce insights. For the competitive environment, ADP operates in a highly competitive market for HR and payroll solutions. The market includes a mix of traditional and cloud-native providers. If you go online and you read Reddit and other sources, it seems like the general consensus is that none of the software solutions are great, but they're a necessary enemy, if you will, and companies have to have this software to run their businesses. So just a few that I've noted here. For ADP, they're a comprehensive HR and payroll solution for businesses of all sizes. For Paychex, they are focused on small to mid-sized companies. We also have Paycom, which is an all-in-one employee management solution. And then two more I've got for the competitive landscape. One is Paylocity. They are cloud-based HR and payroll with user-friendly interfaces. And then Workday, which is also a cloud-based HCM platform, but it also has integrated finance and analytics. So as you can see, there's a lot of competitors, and there's even more than these five, but they all offer a little bit different in terms of value. ADP holds a strong position in the market with a 92% annual revenue retention rate, which matches Paylocity and does outperform other competitors. Notably, ADP also has the lowest beta, which is 0.80 among its peers, indicating lower volatility and potential greater stability. I then looked at customer satisfaction, and while ADP's customer satisfaction and net promoter score on Comparably are higher than Paychex, they do lag significantly behind cloud-native competitors like Paycom and Workday, so this suggests room for improvement. I've then integrated a Porter's 5 forces of the industry. So in terms of competitive rivalry, I have this as high with several established players and emerging cloud-native companies. For buyer power, I do have this as moderate, as switching costs can be high due to integration and data migration challenges. Supplier power is low, as ADP primarily relies on proprietary technology and services, as well as many of their competitors. The threat of new entrants is moderate. I have this because it's due to the high initial investment and established trust of incumbents. However, SaaS has a low barrier to entry, so I think that's why you see a lot of SaaS competitors for ADP, and thus I have moderate for threat of new entrants. And threat of substitutes, I have this as low. HCM solutions are essential for businesses, and they're really difficult to replace with in-house solutions. Lastly, I'd like to look and understand what the industry competes on. So a few things I've noted here for this industry. They compete on product and service quality, also on reputation, ease of use of technology, the breadth of their product offerings, as well as price. In terms of growth projections for the industry, ADP anticipates that the broader HR services market will grow at an annual rate of 5 to 6%, with the company slightly outpacing this growth. Within this market, the human capital management or HCM software segment is projected to experience a more robust growth rate of around a 7 to 10% CAGR through 2030. It's also worth noting that the industry is seeing a moderation in growth rates among several of ADP's key competitors. For instance, Paychex is reporting low to mid single-digit revenue growth, while Paycom's revenue growth has now slowed to 10 to 15%. Additionally, Paylocity and Workday, who have typically grown revenue at the highest rates, have seen their growth drop to the upper teens, with Paylocity now forecasting an 8% revenue growth for fiscal 25. The jury is still out on if ADP can capitalize on opportunities in the faster growing HCM software market, given that their competitors are cloud native and may have an advantage. Having provided an overview of the business and industry, I will now examine how ADP generates and recognizes revenue, its marketing approaches, supply chain operations, and pricing power. I'll then assess their high quality qualitative and quantitative attributes. First, revenue generation and recognition. ADP generates revenue primarily through three sources: payroll processing, professional employer organization services, and interest on client funds. Payroll processing remains the largest contributor, consistently making up around 65 to 70% of total revenue, and PEO services have actually been the fastest growing segment. ADP recognizes revenue based on a fixed fee per transaction, such as the number of payees or payrolls processed. The performance obligations are considered a series of distinct services satisfied over time, with revenue recognized as services are performed. ADP's business is characterized by long-term client relationships, resulting in recurring revenue. Recurring sales constitute the majority of ADP's revenue due to ongoing payroll processing and HR outsourcing services. One-off sales are minimal and typically involve setup fees for new clients. Key sales drivers for ADP include new business bookings, client retention rates, interest on client funds, pricing strategies, and general market labor trends. For marketing, there's really not much to talk about here given the nature of their business, but their 10K does mention that they primarily market their solutions through a robust direct sales force of highly trained associates. They also utilize indirect sales channels, including marketing relationships with CPAs and banks. We will talk a little bit about pricing though, and I break pricing down into pricing power and price elasticity. For pricing power, I have this as moderate. I do think that ADP does have some pricing power, and you'll see this mentioned on their earnings reports, which I've got here as Q3 24, where they talk about their ability to increase prices by 100 to 150 basis points while being also mindful of client retention. For price elasticity, I have this as relatively inelastic, mostly because payroll and HR services are essential for businesses, leading to lower price sensitivity. High switching cost and long-term contracts further reduce elasticity, although ADP must balance pricing with those retention strategies. Next, we'll talk about qualitative high-quality attributes. The first thing I look at here is the Morningstar moat rating, if there is one for the company. And ADP is given a wide moat rating from Morningstar, primarily due to high client switching costs, which make it challenging for customers to transition to competitors. Additionally, they do benefit from significant intangible assets, including their strong brand reputation and an extensive referral network, and then also the unique ADP marketplace, all of which reinforce that competitive advantage. And then I like to choose two qualitative attributes for the company that I'm reviewing. The first one is their customer base, and I really think this is something that's unique for ADP and also their industry. ADP boasts a high customer retention rate, with an estimated client retention of approximately 13 years in employer services and about 6 years or so in PEO, according to various online articles. This strong customer loyalty is diversified across various sectors and industries, which really helps provide them with a stable and broad client base that contributes to that consistent revenue growth. The next qualitative attribute that I'd like to highlight for ADP is financial stability through their recurring revenue. Their business model is characterized by long-term client relationships, as I've mentioned earlier in the episode, and this results in recurring revenue, which provides stability and predictability in income. This recurring revenue stream, coupled with their high client retention rates, allows ADP to maintain consistent financial performance and invest in future growth initiatives. We'll next talk about some quantitative high-quality attributes that I like to analyze for every company on the podcast. First, is their annualized price return CAGR greater than the S&P 500 since Portfolio Visualizer tracking began? For ADP, this is yes. From June 1997 to September 2024, ADP has beaten SWPPX 12.4% to 9.2%, with a slightly above average correlation of 0.60. The next question is, are there any EBIT operating losses over the last 10 years? Ideally, we're looking for none, and this is actually the case for ADP, so that's good to see. Third is Guru Focus predictability score, at least a 4 out of 5. In ADP's case, this is a yes, it's actually a 5 out of 5. So a highly predictable business model, as we just discussed with that recurring revenue aspect. Finally, in this section, we'd like to look at is the 10-year free cash flow linearity at least 0.75. So is free cash flow highly predictable? In ADP's case, this is a yes, it is at 0.90. The next area we'd like to look into is margins. First question that we ask, is 10-year average gross margin at least 40%? For ADP, this is a yes again, as it's 44.9%. Their gross margin has shown a gradual uptrend over the 10-year period, with fiscal 2024 the highest gross margin percentage at 47.9%. Next is the 10-year average stock-based compensation adjusted free cash flow margin, at least 15%. Once again, this is a yes, it is 17.1%. The next section is quality growth. First question is 10-year revenue CAGR at least 5%. This is yes again for ADP, which they have a 10-year revenue CAGR of 5.8%. And it really demonstrates their ability to grow the top line, outpacing that 5% benchmark. It is worth noting, though, that they're definitely on the lower side of some businesses that we've analyzed, and there aren't really any expectations for their revenue to grow double digit in the next few years. Next is 10-year free cash flow per share CAGR, at least 10%, at least double digits. For ADP, this is yes again, with a 10-year free cash flow per share CAGR of 10.8%. ADP has also shown impressive growth in its cash generation ability, reflecting improved operational efficiency and scalability of its business model. The third question in this section is 10-year average free cash flow conversion at least 100%? So in this question, we want free cash flow per share to be higher than net income per share or earnings per share. And ADP's case, that is a yes. So the 10-year average free cash flow conversion rate is actually 113%, which shows that ADP consistently generates more free cash flow than its reported earnings. And this suggests that they have high quality earnings and effective management of working capital. To round out this section, we'd like to look at two questions around returns and efficiency. The first question is 10-year average ROIC, return on invested capital, at least 20% and higher than its 2023 industry average. The 10-year average ROIC for ADP, based on stockanalysis.com data, is approximately 30%, which is higher than both my top quartile database benchmark and the 2023 industry average from the NYU database of 28%. The trend shows that ADP's ROIC has generally been increasing, particularly in recent years. The second question we'd like to look at is ROIC consistently at least 2% greater than the WACC, their cost of capital. So when evaluating ADP's ROIC against its WACC, discrepancies do arise. While I typically rely on Guru Focus, since they're one of the few providers that has WACC available on the internet, their ROIC figures for ADP are in the mid to high single digits on Guru Focus, which would actually be falling below the WACC for 3 of the last 5 years. This contrasts with higher ROIC figures from sources like Stock Analysis and QuickFS, which report consistent rates above 30%. Now, I do know that there are different ways of calculation between the sources, and it just highlights the importance of cross-referencing data and understanding the methodologies used, as it may impact perceptions of ADP's value creation. After analyzing ADP's business model and high-quality attributes, I will evaluate their key growth areas and risk factors. Each element will be assessed based on 2 dimensions: the likelihood of occurrence and its potential impact on the business. This approach will provide a comprehensive view of the company's future prospects and potential challenges. First, growth areas. Overall, I rate ADP as having medium growth potential, with a lot of the bull thesis banking on areas that only have a medium likelihood of occurring. However, they should be able to return a medium-term, mid-single-digit yearly organic revenue growth and double-digit EPS growth, which is a nice baseline to build off of. So with that said, the first growth area that I have is international expansion. This I have as medium likelihood and high impact. While ADP operates in 140 countries, less than 15% of sales come from international markets. This presents a significant opportunity for growth, especially in emerging markets where HCM solutions are in increasing demand. I rate this as medium likelihood since ADP hasn't really significantly increased their international business over the last 10 years. It's actually hovered between 12.8% and 14.5% of sales, but high impact since getting to a long-term average of 30% or so of sales would really help grow the top line and diversify the business. Second, generative AI integration. This I have as medium likelihood and medium impact. ADP is rolling out ADP Assist, which uses generative AI to surface insights, aid decision-making, and streamline tasks for clients and their employees. This technology could significantly enhance their value proposition, potentially increasing sales in their largest but slowest growing employer services segment. And I rate this as a medium likelihood of happening since their CEO has been talking about it on recent earnings calls, and ADP has the resources to innovate, but they're not known as a cloud-first business, so it's no guarantee here. I rate it as medium impact since it's uncertain how this will all actually help the bottom line, but it will certainly help their reputation as a legacy player. The third area of growth I have is upsells to existing customers. This is medium likelihood and medium impact. With only 50% of new business bookings coming from upgrades versus net new business, there's substantial room for growth within ADP's existing customer base. The company's comprehensive suite of HCM solutions allow for cross-selling and upselling opportunities, particularly in its PEO services segment, where management believes they could gain 25 to 30 million new clients just from the existing customer base. I rate this as medium likelihood since achieving significant growth may be challenging due to the competitive landscape, especially as pricing pressures occur in the future with some of these new technologies, and varying client needs, and medium impact since it would help support incremental revenue growth, but not impact the business as much as other growth areas. Next, let's talk about a few risk factors. Overall, I rate ADP as having medium to high risk potential due to 2 of the top 3 risks having high impact to the business. The first risk I have listed is technological disruption by competitors. This is a medium likelihood but high impact risk. The HCM industry is rapidly evolving with new technologies, and if a competitor develops a groundbreaking solution, or if ADP fails to keep pace with technological advancements, it could and has been losing some market share. This risk is particularly relevant as the industry moves towards more AI-driven solutions, requiring ADP to continuously innovate and adapt. The second risk I have listed is cybersecurity and data breaches, with low likelihood but high impact. As a handler of sensitive personal and financial information for millions of employees, ADP is a prime target for cyber attacks. A significant data breach could result in severe reputational damage, loss of client trust, and potential legal and financial repercussions. Continuous investment in robust security measures will be crucial for ADP to mitigate this risk. The third risk that I have is economic downturns affecting labor markets with a high likelihood and medium impact. ADP's business is closely tied to employment levels and wage growth. Economic recessions do occur, and significant job market contractions could negatively impact ADP's revenue, as fewer employees mean fewer payrolls to process and potentially reduce demand for their services. This risk underscores the importance of ADP's efforts to diversify its revenue streams and expand internationally. Next, I want to briefly discuss some key metrics to track for ADP. To accurately assess a business's health as an investor, it's crucial to monitor at least a few key metrics. Each industry has its unique set of metrics, and each person evaluating a business might as well. And in the context of ADP, I'm providing 3 KPIs that I believe are particularly relevant to track as an investor of this company. The first KPI is client revenue retention rate. This metric measures the percentage of recurring revenue retained from existing clients, which for ADP has consistently remained above 90% since fiscal 2011. A high retention rate indicates strong customer loyalty and satisfaction, essential for sustainable, predictable revenue streams in the competitive HCM market. This metric, in my opinion, could be better presented in the 10K, and I don't think it's in every 10Q, but you can find it if you look for it. The second KPI is employer services new business bookings growth. Tracking the growth in new business bookings within ADP's largest employer services segment provides insight into the company's ability to attract new clients and expand its market share. Finally, the third KPI that I think investors should track is PEO Services average worksite employee growth. This KPI reflects the growth in the number of worksite employees served by ADP's second largest segment, the PEO Services. And with over 3 million worksite employees currently served, monitoring this figure can reveal trends in ADP's ability to scale its PEO offerings and capitalize on growing demand for outsourced HR solutions. Next, let's dive into the financial landscape of ADP by exploring the key highlights from their three financial statements. First, the income statement. For the income statement, I start with operating expenses, and ADP's primary operating expense is SG&A, which has hovered between 47 and 50% of total revenue over the last 3 years, with a decreasing trend. There is also R&D, which has been between 4.7 and 5% the last 3 years, with an increasing trend. I think you'll generally see more R&D intensity in this industry as new AI tools are developed. It's worth noting that other competitors such as Paychex, Paycom, and Workday spend over 10%, with Workday leading the pack at over 30% of revenue invested in R&D. Workday also dwarfs ADP from an absolute perspective. They spend $2.5 billion in R&D to ADP's $956 million. So it's pretty clear that ADP is going to need to spend more on R&D to remain competitive in the future. I'd then like to look at net financing cost. Tracking net financing cost is an underrated income statement metric for understanding how effectively a business manages its debt obligations via interest expenses relative to its earnings on interest income. The closer this number is to zero or negative, the better. In fiscal 2024, ADP reported net financing cost of approximately $361 million, a significant increase from the $253 million in fiscal 2023. These costs have also risen as a percentage of net income, now representing 9.6% or nearly 10% of net income. I then like to look at a company's interest coverage. This is similar to net financing cost, but measures how effectively a company can meet its interest obligations based on operating profits. Interest coverage ratio for fiscal 2024 was 13.8 for ADP, which was down from 18 in 2023, but still indicative of strong financial health. I really like the interest coverage ratio to be above 10 or at least the industry average. For the balance sheet, I like to start by looking at the largest assets and largest liabilities. As of Q4 24, ADP's total assets were $54.4 billion, which was a 6.8% increase from $51 billion in 2023. Key assets include funds held for clients. This is at 74% of total assets. Also, accounts receivable, which is approximately 6% of total assets, and cash equivalents, which is approximately 5% of total assets. Total liabilities amounted to $49.8 billion, which was up 5% from $47.5 billion in 2023, with significant components including client fund obligations at $40 billion, or 80% of total liabilities, also accrued expenses and other current liabilities at 6 to 7%, and long-term debt at around 6%. ADP's goodwill stood at $2.4 billion in fiscal 2024, which is approximately 4% of total assets. This is well below my 30% threshold for goodwill and the 28% average from Professor DeMordian's database, indicating that goodwill does not pose a significant risk regarding asset valuation. Latest quarter trailing 12-month debt-to-equity ratio is currently at 0.81, which reflects a stable capital structure. Latest quarter cash-to-debt ratio stands at 0.79, indicating that the company has 79 cents in cash for every $1 of debt. This ratio has shown a slight improvement over the past year, reflecting a trend towards strengthening liquidity despite the challenges posed by rising debt levels. For this ratio, I usually aim for 1.0 or above, but this is still very solid. As of Q4 24, ADP has $3 billion in corporate bonds with staggered maturities in 2025, 2028, and 2030, providing flexibility for refinancing and growth. Overall, it seems that ADP has a very solid liquidity and solvency position, although it's worth paying attention to the increase in net financing costs in the future. I'd then like to take a quick look at shareholders' equity. ADP does not have any preferred stock, which simplifies its capital structure. The company holds $231 million in treasury stock, which represents about 13% of total outstanding shares. This suggests a significant buyback program and management's confidence in the company's long-term value and commitment to returning capital to shareholders. As of Q4 24, ADP's retained earnings were $24 billion, demonstrating strong profitability and growth over time. Overall, ADP's shareholders' equity reflects a solid financial foundation. For the cash flow statement, I like to look at three things: stock-based compensation intensity, which is stock-based compensation divided by revenue, capital intensity, which is capital expenditures divided by revenue, and investment intensity, which is capital expenditures divided by depreciation and amortization. Over the past 10 years, ADP's SBC intensity has consistently remained below my 10% of revenue benchmark, with a range of 0.3% to 6.3% and an average of 4.7%. This is a little higher than the industry average of 1.4%, but it's also worth noting that for fiscal 24, the ratio was only 1.3%. For capital intensity, this has consistently remained below 5% of revenue over the past 10 years, with actually only 1 year, 2015, slightly exceeding this benchmark at 5.3%. The 10-year average CapEx intensity stands at 2.9%, while fiscal 24 was at 2.8%, both of which were slightly higher than the industry average of 1.7%. ADP's investment intensity ratio stands at 100% for fiscal 24, with a 3-year range of 100 to about 104%, indicating a focus on maintaining its existing business. In contrast, Paycom demonstrates a more aggressive investment strategy, with investment intensity ratios ranging from 143% to 179% over the past few years. We'll now shift our attention to management. This section will evaluate the company's leadership structure, compensation practices, and capital allocation strategies. First, a leadership overview. ADP is not founder-led. The founder, Henry Taub, actually passed away in 2011, and Maria Black has been their CEO since January 2023, with a tenure of approximately 1.5 years. While this is below the U.S. average of 4.8 years, she has been with the company since 1996, indicating deep institutional knowledge. Her total compensation for fiscal year 2024 is $18 million, with only about 7% or $1.2 million as base salary. The majority of her compensation, around 80%, is in long-term incentives, aligning with performance-based pay principles. ADP would currently be classified as a long-tenured manager. As you may remember from our last episode, we have classified companies now from most to least knowledgeable with owner-operator, long-term tenured manager, or hired hand as the options. And this is because she has worked at ADP for over 25 years. I then like to look at Glassdoor metrics. So they have a 74% recommend to a friend rating, which is slightly below my database's 81% top quartile benchmark, but still a very respectable score. They also have an 85% approval of the CEO rating, and 73% have a positive business outlook. Overall, the Glassdoor metrics look pretty good for ADP. ADP's compensation philosophy emphasizes pay for performance and aligning executive interest with long-term stockholder value. This is particularly important given the low insider ownership of less than 1%. ADP's compensation structure for executives includes base salary, which, as I mentioned, represents a small portion of total compensation. Also, an annual cash bonus, which is based on financial and strategic performance metrics. And then there's also a long-term incentive component, which is primarily in the form of performance stock units and restricted stock units, which together make up the majority of executive compensation. The use of PSUs and RSUs does align with rewarding long-term value creation, so this is nice to see. ADP does use an independent compensation consultant, which is a common practice but should be monitored for potential conflicts of interest. ADP uses a mix of financial and non-financial metrics for its annual cash bonus plan. It includes revenue growth, new business bookings growth, adjusted EBIT growth, transformation objectives, client satisfaction, and ESG objectives. They all make up around 10 to 20% of the cash bonus plan. For long-term incentives, ADP uses metrics such as total shareholder returns, or TSR, relative to the S&P 500. The inclusion of non-financial metrics like transformation, client satisfaction, and ESG objectives alongside financial metrics provides a nice balanced approach to performance evaluation. For capital allocation, Morningstar assigns ADP a standard capital allocation rating, indicating a sound balance sheet, fair investment efficacy, and appropriate shareholder distributions. Additionally, they also have a high AA3 credit rating from Moody's, underscoring their financial stability. ADP's primary uses of cash are on organic reinvestment, M&A, and returning value to shareholders through dividends and buybacks. This strategy aligns well with ADP's mature business lifecycle stage, balancing growth initiatives with substantial shareholder returns. ADP has a robust dividend strategy and has solidified itself as a reliable dividend aristocrat. I am not personally a dividend investor, but those who are may want to pay attention to their current payout ratio. As of Q4 24, it's around 60%, and I usually have a benchmark around 50%, so this is a little bit higher than what I like to see. You can also look at free cash flow payout ratio, and this stands at 61% for fiscal 2024, which has a similar story to the standard way of reporting payout ratio. ADP also actively repurchases shares with a $5 billion repurchase authorization approved in November 2022. As of Q4 24, ADP repurchased 1.8 million shares at an average price of $245 a share. With the current price around $293, those buybacks are looking good right now. I'd then like to look at the M&A strategy and any recent notable acquisitions. ADP prioritizes M&A as a key component of its capital allocation strategy, ranking it second actually after organic reinvestment and before dividends and buybacks. While the company does not explicitly outline its M&A process in its 10-K filings, recent acquisitions such as the purchase of Sora in 2024 indicate that management focuses on expanding their product portfolio. I actually like to calculate a metric, and this is called acquisition intensity, and it's acquisitions as a percentage of operating cash flow. If you look at this ratio over the past 10 years, ADP's average acquisition cost as a percentage of operating cash flow is 10%, driven by significant acquisitions in 2015 and 2018. Excluding these outliers, the average would be much lower, suggesting that while ADP does not frequently engage in acquisitions, when they do, they tend to be substantial relative to operating cash flow, around 25 to 40%. For total shares outstanding, the 5-year trend in diluted shares outstanding shows a consistent decrease from 433 million in 2020 to 412 million in 2024. This represents a 4.9% reduction over those 5 years, or about 1% per year, meeting my reduction criterion. The total shareholder distribution, which is dividends plus buybacks divided by free cash flow ratio, has ranged from a low of 76% in 2023 to a high of 137% in 2015. Generally, over a longer time period, I like to see this ratio below 100%, and the trend for ADP indicates a general decrease in this percentage, particularly in the most recent years, suggesting a more balanced approach to returning capital to shareholders. I'd then like to look at ownership structure, which will assess the level of insider commitment and institutional confidence. For insider ownership, this is less than 1% according to Market Beat, which is significantly below my ideal 10% benchmark. This low level of insider ownership means that management compensation structure and incentives becomes even more critical in ensuring that executives are motivated to act in the best interest of shareholders. Institutional ownership for ADP is approximately 80%, which is above my 75% benchmark. This higher level of institutional ownership suggests that professional investors and money managers have confidence in ADP's business model and future prospects. It can also indicate a higher level of scrutiny on the company's performance and governance practices. The last section, valuation and technical analysis, will assess ADP's intrinsic and relative value using several valuation methods, while also examining key technical indicators such as long-term price trends, moving averages, and volume profile. First, valuation. I'll start with the DCF from investorsgrow.com. Using a 9% IRR, a 2.5% perpetual growth rate, and 4 years of analyst free cash flow forecast, which is 13 total analysts, ADP's fair value is $216, which is about 26% overvalued versus current price of $290 as of November 4th, 2024. Next, a reverse DCF from Stock Investor IQ. Using trailing 12-month free cash flow per share, a 9% IRR, and a 15 price to free cash flow terminal multiple, which is the historic average for all stocks, ADP needs free cash flow per share to grow around 13% per year for the next 10 years to justify current price. This is actually right in line with their 5-year percentage at 13% and their 10-year average, which is at 11%. I'll then look at a free cash flow yield from stockanalysis.com. Their trailing 12-month free cash flow yield is 3.31%, while 2025 free cash flow yield is 3.63% if you take analysts' free cash flow forecast for 2025 of $4.3 billion. Both percentages are slightly higher, around 7 to 18% higher than the 3.08% 10-year average. Using an average of trailing 12-month and 2025 expected free cash flow and the 10-year yield, fair value would be around $288. Then I'd like to look at a couple multiples on Guru Focus. First, EV to EBIT. Their current EV to EBIT is around 22.7, which is greater than the 20.8 10-year median, and also greater than the 17.9 software industry median. It appears that Guru Focus hasn't yet changed their industry classification for ADP, so this median might not be as relevant moving forward. Their 10-year median multiple implies a stock price of around $265, which indicates about 9% overvalued. Next, EV to revenue. This is currently 6.2, which is also greater than the 4.9 10-year median. Their 10-year median multiple implies a stock price around $229, which is 21% overvalued. The various valuation methods suggest that ADP is slightly overvalued, with estimates ranging from around 9 to 25% above fair value. It is worth noting, though, that reverse DCF and free cash flow yield are the most optimistic, so if you feel most comfortable about those assumptions, this company could be a buy right now. Lastly, technical analysis. So the first thing I like to look at from a technical analysis perspective, and I should note that this is all on TradingView, are they on a long-term 5+ year price uptrend? For ADP, the answer is yes. Their stock price has really actually taken off since COVID. I then like to look at is the short interest low, medium, or high. The short interest for ADP is low at around 2% of float. This is well below the 5% threshold that I consider bullish, suggesting that there is little bearish sentiment or expectation of price decline among investors. I then like to understand how their current price compares to their 1-year and 5-year 200-day exponential moving averages. Their current price is $290, and their 1-year 200-day EMA is at $235, and their 5-year 200-day EMA is at $224. So ADP's current price is significantly above both its 1-year and 5-year 200-day EMAs. This is a bullish signal, indicating strong upward momentum. Based on the 5-year chart, there are 2 notable volume shelves that could serve as potential entry points or support levels for ADP. The first one is $235 to around $245. There's also $210 to $220. This is another volume shelf that could serve as a secondary support level if the price were to pull back significantly. These volume shelves suggest areas where buyers have shown interest in the past and can potentially step in again, making them attractive entry points. Overall, ADP stands as a formidable player in the HR services and HCM industries, demonstrating strong financial performance and strategic positioning. The company's wide moat, high customer retention rates, and consistent financial metrics underscores its quality. ADP's focus on international expansion, generative AI integration, and upgrading sales to existing customers presents interesting growth opportunities. However, the company does face challenges in a highly competitive landscape and must continue to innovate to maintain its market position. So what is my investment strategy? I am placing ADP in my watch list with a buy range in the secondary support shelf of $210 to $220, where I'm seeking a slight margin of safety given the competitive nature of their industry and ADP's below average NPS and CSAT scores. And that wraps up today's episode of Stock Spotlight. Hope you found my analysis of ADP both insightful and actionable. If you enjoyed today's episode, please subscribe, leave a rating, or drop a comment. Your feedback helps us grow. For real-time updates and insights, follow me on X at invest091. Join me next on November 20th when we'll discuss entering positions and portfolio tracking. Until then, keep your investments smart.